This is Bloomberg ETF IQ. I'm Scarlett Fu along with Katie Greifeld.
And Eric Balchunas still isn't here, so I'm going to do today's drill down where we focus on one ETF. And in the hot seat today, we have the DoubleLine Opportunistic Core Bonds ETF. The ticker there is DBND, as I like to call it. Basically, this invests across the fixed income landscape. It has almost $500 million in assets. That's since it launched in 2022. Charges 45 basis points for this actively managed portfolio. Let's take a little look at what it actually holds. This is interesting. 48%, 49% of the portfolio is in mortgages. And then we get into government and corporate bonds as well, but definitely a heavy weighting there to mortgages and specifically to U.S. securities. I want to take a look at performance here. We're comparing this fund to the ag, and you can see that it's outperforming since its inception, up about 6% on a total return basis. You compare that to the ag, to its benchmark, which is only higher by about 2% in that time frame. So active management outperformance for 45 basis points. There you have it, Scarlett.
All right, good stuff, Katie. Thanks for the intro. And joining us now to talk about this fund is DoubleLine CIO Jeff Sherman. Jeff, always a pleasure to speak with you. Deputy CIO, I should say. Yeah. Katie gave us the overview of DBND. Why mortgages? Why does it have such an outsized representation in the fund?
Well, if you look at the mortgage market, it got disrupted really about 3 years ago, and that's kind of twofold. One is there was a big buyer base that left. I think his big name is Jay Powell, right? The Fed stopped buying some. Yeah, he's kind of famous these days. He's made a lot of headlines last week, right? But also banks didn't have as much demand, and they had stepped away. But remember, banks were heavy buyers back in 2020 and 2021. Well, what that's done is that's led to a spread on mortgages, and these are government-backed assets. And today, I mean, there's some risk involved with it of like prepayments and things that get complex. But you can buy current coupon mortgages that trade about 150 basis points over treasuries, right? You can manage that risk. You can manage some of that prepayment. You compare it with lower coupon and older seasoned mortgages. I'm talking about seasoned back from 2020 and 2021. But if you put those things together, you can get a spread that's around 100 basis points or so. Well, that's more than corporate bonds today, right? And so it's not that we dislike corporate bonds, right? We think corporate bonds are a stable piece of the portfolio, as Katie pointed out. A quarter of the fund sits in that today. But really the representation and the spread you're getting out there, why do you need to take this incremental credit risk? And so that's a big reason. And then secondly, there's this other part of the market that's called the non-agency mortgage market, which has a lot shorter life. And so it's a way of managing the spreads and the durations of the portfolio today. And if you look at a lot of our credit book, what you'd see is that it is on the shorter duration side of it. Why is that? One, it's managing the volatility today. But more importantly, it's because that incremental spread, you're just not getting a lot from the corporate markets today. And so those mortgages do offer a really good and compelling opportunity.
Well, sticking with mortgages, of course, there's a lot of talk about potential privatization of Fannie Mae and Freddie Mac. I feel like we often talk about it from the equity investment perspective, but as a big holder of mortgages, one of the concerns that's out there is that this could cause ultimately MBS spreads to widen out. What's your view?
Yeah, I'm not sure if it causes, maybe short term, there would be some just forced selling instantaneously, but ultimately it just depends on what that looks like. I don't think a privatization means that existing mortgages will lose that government backing, or the guarantor who steps on the private side would be there. I think the issue becomes, Katie, is new origination, right? And so if you think about it, the timing of this right now, right? You have housing that has highest levels of unaffordability, right? House prices are at all-time highs in most areas. You know, the requirements for the down payments, it's very expensive, right? So the way of kind of proxying that is go to the non-agency mortgage market. Well, in order to do that, you would have to get an incremental spread. So this would make housing a bit more unaffordable when we're already talking about it today. So I feel like the timing is really bad. I don't really understand why we need to do this. We had this kind of quasi-public-private, 20 years ago. It didn't work out very well. And so it is one of the gems in the U.S. asset portfolio. If you think about what the U.S. does well, it is actually the government-backed mortgage market.
Yeah, it's the envy of other countries, certainly. Let's talk a little bit about where you see things headed for the Federal Reserve. You mentioned a guy who's been in the news lately, Jay Powell. Right now, market participants are still counting on 2 rate cuts this year. Does that sound appropriate to you?
It feels right, but it also feels wrong. And so what I mean by that is that I think it's a probabilistic weighted thing. And so the way I view it is that I think Jay Powell shouldn't cut rates today, right? If we look at the latest inflation data, it is starting to tick up a little bit when you dig into core goods, you start to see some of that tariff pressure appears to be building. Again, it's 1 month, so we won't make a big deal of it yet. But we do think inflation has bottomed for the year. Take a look at break-even spreads, right? The market participants have started to put that in the 1 and 2 year kind of break-evens in a tips market. So when you start to look at where the market is pricing, they're asking about that. They're pricing cuts, but they're also pricing higher inflation. And so when I think about Jay Powell and what he said over the last few meetings, right, he's focused on the labor market, right, because the inflation data isn't supportive of the rate cut yet either. And so I think you would have to see degradation in labor. So when I say it feels right, it's kind of like on the basis of, well, if they have to cut because there's erosion in labor and a weakening economy, and maybe on that side you get to that kind of 50 basis points. So right now we're kind of playing for no rate cut today, but then you have this concept of the shadow Fed, right? What happens on that? And that was floated last week, and that you see how the bond market reacted. It did not like that whatsoever. And so there's been a lot of headlines about trades to put on for that. We have one on as well. We have the same trade everybody's talking about.
Tell us about it. What is that trade?
Well, it's in DBND, is inside of there, and it's called a steepener trade. So we're long the 2 year and short the 10 year just to play that trade. Now, why would you do that? Well, if you think about the idea, I say no rate cuts. Why do I on the 2 year if there's no rate cuts? Well, let's say, for instance, that someone gets floated out because they get recommended as the new chairperson. They get active on, I don't know, Truth Social, X, whatever that may be, and they start to pound the narrative of lowering rates. One, does that pressure Jay Powell to lower rates? Potentially, not sure. We'll have to see how that plays out. But more importantly, the market's going to look through Jay Powell's tenure and say rate cuts are coming as soon as a new person comes in. So that kind of puts pressure there. But we're still talking about inflation. We're talking about tariffs. You're loosening monetary policy while you have that. It probably leads to a steeper yield curve as well. So there's a lot of conflicting signals in the Treasury market. So you saw how many that we own a fair amount of Treasuries. They tend to be in that kind of front end or belly of the curve. We have a little bit for some protection out there, but we've been really wholesaling, ignoring the 30-year part of the market, and we think that that part of the market is rife for still more pressure in rate movement upward.
Well, I want to talk about what the catalyst would be there, because I hear what you're saying when it comes to the front end. Basically, 2 year yields fall in anticipation of someone else coming in, but it feels like the long end, the 10 year, the 30 year has been pretty unpredictable as of late. And you think about the steepener trade, that's been breaking hard for years now.
But it's all about timing, right? And so, look, we put it on in 2022. We took it off. It wasn't working. It's costly to do, but it's getting less costly. Now, the problem you have now is because the Fed hasn't cut rates, you got to borrow at SOFR in order to do that trade. So you kind of have a little bit of a negative carry. But ultimately, it's paid off. We've had it on for roughly about 9 to 10 months now. We still like it because it helps provide some protection, right? So it's not that we're doing it in massive size to say this is the one trade, it's a one-trick pony in the portfolio. It's a key element there. Further, we own a lot of short duration credit. If rates come down that side, those bonds will rally as well. So there's exposure in the portfolio two ways. But ultimately, if you look at treasuries, they've been very range bound, right? And really range bound, I'll even go back to really, let's say, like the fall of 2022. The 30 years been having trouble breaking above 5%. It's done it for a couple days. That seemed, we had a big auction, market came in. I think people are trading it though. And to me, I don't like the trade. It's very volatile, right? It's very risky, I think, in that standpoint. And by the way, we haven't even talked about the fiscal elements, right? I mean, for all this talk about Doge and, we're going to cut government spending, I don't know, I saw something about we raised the debt limit by $5 trillion. That sounds to me that they're ready to spend more and more. So I think that you have all this together. You have the Japanese market too. We had the elections, yesterday. So there's just a lot of pressure in sovereign debt globally. And so I think that's why you're seeing what you call unpredictable in the Treasury market on that back end of the curve today.
Is it perhaps just safer to count on a rate cut on June 17, 2026, because that will be after Jay Powell has left, his term has ended for sure?
But why bet on that today, right? And so here's the other thing. So why do we need to take a bet, right? Why don't we own things that are stable, that earn income? So you look at the dividend yield on something like DBND, we're close to 5.5%. It's about between 5.25 and 5.5. Those are the bonds we're buying today. And they have short lives, right? So they're going to pay us that cash flow. They have pretty good predictability. And one thing we're trying to manage right now is volatility. So this isn't a market, to me, when we look at valuation, where we need to stretch, that we need to go out and take meaningful risk because you're not really being paid for it. And like you said, it's unpredictable on the rate cuts. So, what happens if there is no rate cut, right? Then you want to own very front-end assets. So we have some floating rate debt that does that too. So when you start to really dig through the portfolio and you look at the construction, there's a lot of things that have an interplay across them, and we're trying to bring stability to investors today. And that's what DBND was designed to do, and it's designed to go anywhere as well. And look, we've been talking about the non-dollar trade and those type of things too. And look, those will enter the portfolio at some point this year.
And Jeff, we have less than a minute left, so this isn't a fair question at all. But when it comes to duration or credit risk, what do you feel more comfortable taking? Because it sounds like you're not super comfortable with either.
Yeah, we're balanced right now, and so we cut risk back in February on some of the credit positions. Just we thought valuation was stretched. There was increased uncertainty. We still have that today, by the way. August 1 is coming now as a tariff. You see the EU, they're coalescing to talk about how to be retaliatory potentially if there's no deal.
Right.
I mean, we haven't removed these risks from the market. The market's moved on from the risks. So I think they're still there. I think you want to own both, you know, and that's the thing. That's the thing about running a portfolio is you got to be able to balance those out.
All right, that's a great place to leave it. Always great to see you, especially in person. That is DoubleLine Deputy CIO Jeff Sherman.